afternoon and welcome to BizTech's Asian Midday Market Watch. It's Tuesday, the 22nd of August, and we have for the first time on the show, Redmond Wong, market strategist from Saxo Markets. Redmond, this is the first time. Great to have you on the show.
Yeah, thanks a lot. Thank you for inviting me.
Now, Redmond, before we get your insights, we're going to take a look across the region to see how markets have been performing in the first half of the day. But we're going to start first with cryptocurrencies. Bitcoin is just above the 26,000 mark. It's 26,022, down 0.14%. Ethereum is at 1,662. It's down 0.85%. Now, looking across the regional stock markets, we start first with the SGX. That's down 0.07%. Bursa Malaysia, where I'm at KLCI, is up 0.08%. Shanghai is down 0.28%. The ASX All Ordinaries is down 0.03%. The Nikkei is up 0.84%. The Hang Seng is up 0.06%. And rounding up the numbers, we've got the Kospi, which is up 0.32%. Redmond, it's pretty much green across the region. Tell us why.
I think it's since yesterday. I think especially the tech did pretty well. I think it's ahead of the Nvidia earning announcement. People is get building position again on the tech name, and so that helped the market sentiment a bit. And also, I mean, it's China has been coming down for quite some time, for several days, and then I think people maybe want to adjust the position a bit, and then so it's the market looks a little bit stabilized today.
Now, all eyes this week on Jackson Hole, but on the back of that, we've got an interesting article that came out from Nick Timiraos from the Wall Street Journal. Perhaps you can share some insights on that, and what do you think the impact will be on investors?
Yeah, I think the Jackson Hole and all eyes are in the focus is because it's I think one of the key topics probably will be what the Fed and other central bank will do, and after they have raised interest rates so aggressively, and now they are taking a pause. And so I think the two key things. One is what is the kind of neutral rate, neutral growth going forward, and also what kind of long-term inflation the central bank will be tolerating, so that people will have some ideas of what kind of Fed fund rates that tend to be they will let it stabilize at those levels. The interesting article is that they raised one question is about since 2019. The neutral rate of real growth, i.e., so what the U.S. economy can grow in real term has been, after taking into consideration of inflation, has been fixed at 0.5%. So that is kind of expectation from the Fed. They say so 0.5%, and then you have a target of inflation of 2%. So Fed fund in the long term, they probably around 2.5, but according to the article, he talked to quite a number of those officials. I think 7 out of 17 of those officials and said is probably they actually have an estimate for this long-term neutral rate of real growth in the U.S. higher than 0.5. That means even if inflation rates coming down towards 2%, that may not be the case. And then if you add a real growth rate higher than 0.5, that means the Fed fund rate probably will stabilize at level higher than 2.5. So that may mean that even the Fed is maybe cutting rates next year, and they may not have as much room as the market expecting them to do. And so that's one thing. In fact, today we have another article from him as well. He actually saying many Fed officials still think that they don't want to see a 3% handle in the CPI, so they probably still want to do more. So that is actually create a bit of concern in the market. You can see actually the bond market has been selling off a bit lately, and you have a 10-year yield now at 4.34, and there is some concern about the Fed may, even if they stop now and they take a pause, and they may not be able to cut rates so much going forward. But the stock market is doing pretty well. Mainly it's just focusing back to the tech sector's earnings.
Now, Redmond, you're based in Hong Kong. There's a lot of investor worries now around the property sector, but that's now spread to the shadow banking sector. Walk us through some of the concerns here and the potential investment implications.
Yeah, I think the key thing is the because it is the shadow banking sector is pretty big. You are talking about the asset is you are talking about 20 trillion RMB, and they have a lot of exposure to the property market. So last week we have one of the large what trust company, and that's part of the key of the shadow banking system, and they have some wealth management product and cannot redeem. And so that creates a lot of concern. What that means is that will actually create bigger question mark on the loan portfolio at the bank. And so that will, of course, you see actually banking share has been trading quite weak lately in China and Hong Kong, and down, I think, 11 sections in Hong Kong, banking names, Chinese banking name. And also that's remind us also because the risk, systemic risk in the financial sector. I mean, that China is unlikely to spend or to bail out the property sector because they don't want to re-leverage the economy. Actually, since 2016, China has been in a campaign of deleveraging, starting on clamping down on the shadow banking sector, and then in 2020, and then on the property development. And then also later, they already very concerned about local government debt. They're all related. We don't have time to go into the detail, but they're all related to those kind of lendings to the property sectors and so on. So the Chinese government may provide liquidity to smooth out some of the risk, but it's unlikely them to spend a lot like back in 2008 and 2010, and to spend a lot on to stimulate the economy or to allow the local government to through those shadow banking system to borrow a lot and then to do a lot of spending on infrastructure. I mean, I think the key thing is because the risk in the shadow banking system that may also spill over to the wider economy, and they need to continue to deleverage the economy rather than to do a big stimulus.
So the expectation then is not around a big stimulus still, because the stimulus that has been coming in from China in the last few weeks has really been in drips and drabs.
Yeah. I think they will be providing liquidity to avoid major risk, but they don't. I mean, there won't be a big stimulus, and some of those policy support will be more like industrial policy. So they will be supporting the tech sector. They also probably will encourage to the internet, the platform company to do, instead of just consumer facing, but doing more on the industrial tech side of the internet of everything, and so also in the AI drive, they probably want to, of course, the semiconductor and also the computing power, in the cloud computing power that will help to develop China's AI initiative. Those will be getting a lot of tailwind support from the government. And also some of the technology industry, like in terms of special steel and so on. I think China has identified quite a number of this kind of industry that actually is lagging behind what they call the strangle pole technology or choke point technology, that without them, actually the whole industry may be just like for example, electric vehicle. I mean, it's China is very proud of its development there, but inside a lithium battery, there's something called a separator, and China cannot really make the high-end separator. So I mean, those are what they call the choke point. And the small thing, but you must have it in order to develop the industry. And they will give a lot of support to those industry, and so what your investors may be like investing in some of the tech company, and of course it's the large mega cap like the internet company. They are still looking. I think at this level they probably have some good value, and also some of those ETF through Stock Connect, they are more specialized in some innovative sector. In the Asia market, which we are in outside Singapore, in Hong Kong, maybe we are not as familiar, but we can actually through the Stock Connect, through Hong Kong, you can invest in some of those ETF with a theme in those particular sector and this particular industry. And that may be something better than the investor on the board market. And we tend to also, because of the risk we talk about the shadow banking industry, we also don't want to invest in the Chinese banking sector.
Now, Redmond, fascinating insights. Thank you very much for your first appearance on the show. We really look forward to having you in future shows.
Thank you very much, Brian. Thank you very much for the audience to watch this program.
I'm Brian Fernandez, and we've been speaking to Redmond Wong, market strategist from Saxo Markets, coming to us out of Hong Kong on BizTech's Asian Midday Market Watch. This video will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.